So hi guys, it's SJ speaking, and in today's video, we're going to see about chart patterns. We're going to see about triangle pattern. So before going into the video, I am personally teaching trading. So if you want to join my mentorship course and learn trading from me, you can contact me by the number which is in the video scrolling below. I will give you all the details about my course, and of course, you can earn consistent profits. And I'm also providing discounts for the first 25 members. So if you're interested, you can contact me. So now let's go into the video. So this is the third chart pattern video I have released on YouTube. The first two patterns I was teaching about the head and shoulders, and next my pattern was cup and handle pattern. So this is the third pattern, that is triangle pattern. So various types of triangles you can see. This pattern occurs at most of the times in almost every time frame, ranging from 1 minute to month time frames, daily time frames, 4 hour, 1 hour, 15 minutes, 45 minutes, whatever you see. But mostly, many don't use this 30 and 45 minutes. But still, this pattern takes place in all the time frames. You can look and you can easily spot those time frames. And this is a highly reliable pattern, so it occurs most of the time. So the first pattern is symmetrical triangle. Here is the support, and here is the resistance, and support, resistance, and then support. Then the breakout takes place here. Your entry, aggressive traders enter here, whereas conservative traders wait for a retest. The retest may happen like this, or it can also happen like this. Sometimes you can also combine the supply and demand zones. In this case, it's a demand zone, and sometimes it touches the supply zone here and will go up. It can also occur like this, or it might touch this triangle, the slanting line. So this is what symmetrical is. So it comes down here from top to down, and it goes up from down to up like this. So this is the symmetrical triangle. So you have to buy after a breakout. The three rules for the breakout is, for a high reliable breakout, is the first thing, the candle's body should keep a close, and the second thing, the candle body should be very much longer. It should have a long real body, high momentum candle. Third thing, the volume should also be high. The volume should be high, like this. It should be very high compared to the previous volumes. Then the breakout, higher chances of breakout, the validity of the breakout is high. So sometimes fake out happens. Sometimes the stock price might go like this and it will come down again. It might go up, inducing us to buy those stocks, and then it will come like down this, and we will face loss. So this is what fake out means. So sometimes fake out occurs, but with these two rules, the chances of fake out are less. So target, how to place targets is, you have to take this price range, and you have to measure this from this low till high. So and you can keep this where the stock price breaks out. So this is your target. Sometimes the people might also use the resistance as first target, second target, third target, but it should, when if the stock price is like this, you can use that. But if it's like this, then that might not be a good target. So you can use this type of targets. So from this range to this range, so you can take and keep your targets. So, or sometimes you can also use Fibonacci. So Fibonacci retracement, you can use it. So you can select this swing low to swing high. So it retraces around 0.618. So your target would be this minus 0.618. If it retraces around this 0.5, then your target is minus 0.414. If it retraces around 0.382, then your target is minus 0.272. So this is just an assumption. Usually the market, if it retraces around this level, it will go at most to those levels which I have previously said to you. So respectively. So but this is not always the case. Or you can use this minimum target of 0. So you can also use this 0 as your target if you are taking targets based upon Fibonacci. Stop loss would be some based upon candlesticks, or this below this support you can keep. It is based upon your risk to reward, your risk management. According to your risk you are willing to take, you can keep your stop loss. So usually people keep below this support level, and they keep their targets almost twice as that of the risk. So this is your stop loss and this is your entry and this is your target. So if you're entering based upon this retracement, you can wait for one candle to close above this breakout candle, and then you can take your entry around here, or some even take here, and they would keep their risk to reward ratio as this. So this is lower for them, the risk is lower, and targets accordingly. You can keep your risk to reward ratio according to your risk taking level, according to your risk appetite. So this is it. Then next, coming to the ascending triangle. So this is type 1 bullish. So this symmetrical triangle, it's not only bullish, it can also go bearish. So it can also go like this, can also come like this. So sometimes even retrace doesn't occur. The stock price will shoot up directly. It might not even have a retracement. So it takes place in both directions, either uptrend or downtrend, upside breakout or downside breakout. Whereas ascending also takes place. This is the type 1 and this is the type 2. The difference is, so the top line is the straight line and the bottom only it's like slanting. So this is the difference. So it is similar to that. You can keep your targets based upon this pattern. So this is the length. So this is your target, or based upon Fibonacci, you can keep your targets. So it retraced around 0.6, sorry, 0.5. So around minus 0.414 is your target. So if you are an aggressive trader, so you can take your entry here itself. If you are conservative, you can take at the retracement. So once the retracement occurs, you can also see any bullish candlesticks patterns, and after the confirmation, you can take stop loss either any candle below near this low, or you can keep below this support level stop loss, and then you can trade. So this is type 2. So this is bearish, and then descending. So the bottom line is a straight line. In this case, the top line is the straight. Here is the bottom, and this is the slanting, and this is descending type 1 and type 2. So these are the patterns, and finally this is the expanding. So here in symmetrical, it is contracting, but whereas here it's broadening or expanding. So not only on breakout, you can also trade within these between these lines. You can also trade. So minimum there should be 3 touches for this. Some might say 2, but I prefer 3. 3 touches. Okay. So 1, 2, 3 for this confirm for this pattern to be valid, and you can also trade sideways. You can also keep sell here or buy here. You can always trade within this range too. Not only at breakouts, you can also trade within these ranges. So these are the patterns. These are the 6 patterns. So you can see symmetrical triangle, expanding triangle, ascending triangle type 1, type 2, descending triangle type 1 and type 2. So let's see the live chart. So you can also use the other market structure or candlesticks, supply and demand zones, support and resistance. You can combine these strategies together. So this is the supply and demand zone. So you can see the candle is breaking out. The candle has a high body, and the candle's body also closes. So there is also high volume. So the news is also was good. That is, the oil prices were high due to the Russia-Ukraine war at this point, and since there was also high demand. So this stock also has good fundamentals at that point. The point. So the stock price recently at that correctly when the fundamentals was also good, the news was also good and a good formation. So this chart pattern took place and it shoot up. So your risk to reward, so would be you can see you can take the length. So this is your target based upon pattern. So or you can also you can see the entry, your stop loss here. So you can see your risk to reward is almost 1:2. So sometimes you can also keep this again, you can keep it if you feel that the stock is so bullish, you can also keep like this. So or you can also use your some people enter based upon this support demand zone. Once this demand zone is broken, they enter. So the stock price usually falls again to this demand zone, and it might shoot up again. So there is a possibility of falling again to this demand zone. Sometimes it might fall here, or sometimes it might fall here, or even it might fall around this level, or even it might touch this candle and go up. It depends upon the market conditions according to the buyers and sellers, how much the orders, that is where they are placing the orders. So that is it. So this is based upon Fibonacci. You can see whether you are taking this swing low and this swing high. So the retrace is around 0.5. So according to this Fibonacci, your target would be around this level, which is quite low. Since or you can take this level minus 1.618. You can see it clearly had a resistance around this minus 0.618 level. So this is the beauty of Fibonacci analysis, Fibonacci retracement. So this is the symmetrical pattern. So you can also see here Gokaldas exports. It's recently taking place. Today it has broken out, but the volume is low, but still the candle is high. The body is also closed. So you can keep your targets according to the pattern. You can keep it. The stock might retrace and come down, or it might go up down. So once you are looking at individual stock, before looking into the individual stock, you should also look into the Nifty pattern. That is the overall market, which we call as Nifty. So next, after seeing that, based upon the sector trend, you have to see those sector trend. If you find any pattern in that sector, whether it's supporting your only if the Nifty is bearish and your sector is bearish, there's high reliability of the individual pattern to be successful. If your individual pattern is bearish but the Nifty pattern is bullish, this pattern might lead to a failure. It will look like that as it if it's falling down, but it will come down and go up. It might come down like this, like a breakout, and it is a fake out. It might come up and go up. So you have to see the Nifty pattern, that is the overall market pattern, and then the sector pattern, and then you have to look at the individual pattern. But sector usually mostly many traders ignore it because they feel some might be lazy to look. But looking at that and taking trading is still better. So you can also use this supply and demand. Once this demand zone is broken, you can take your entry, or some might not use this zones. They might take aggressively at this place. So it's safe to take once this zone is broken. You can take here. Some might even wait for a retracement and then they would take your entry after any candlesticks bearish pattern is formed. So this is it. So this is also symmetrical patterns, and you can see here pattern is forming. So the stock price might break out here. There is a possibility, or it might break out here and go up. So here you can see ascending triangle. So no, this is also symmetrical. So this is ascending triangle. It should break down. So type 2. So where it broke down. So this is a pattern where the stock failed. So this is a failure pattern. You can see here the stock target is not reached here. So, but if you have placed your targets based upon Fibonacci, so this is your swing low, and so your target has been reached. So it retested around 0.5, and your target would be minus 0.414. It even went up to minus 0.618. So this is not your default setting. Your default setting will be actually like this. But this is my own thing. I took it based upon this extension. I took this. You can I took this equal to this extension line. I drawn this Fibonacci. So you can use my settings too. So if you didn't watch my Fibonacci video, watch that. I have clearly explained. So some might even use this demand zones. So still, even after this zone is confirmed, there is a fake out. Why? Because there is a resistance here. You can see there is a resistance here. So this is the reason why the stock price came down. So you have to look at the support and resistance. If you didn't know what is the basic support and resistance, you can watch my support and resistance video. So and then the stock price broke down. So so you can also use this stock price broke down. So there is a double top. So I will show you on another video what is double top and double bottom. So this is how the pattern failures. So this is a fake out. Actually, this is the fake out. It's not actually a fake out. Since there is resistance here, the stock price went down. So that's the reason. You have to also look at the other factors. So here is also the failure. You can see clearly, even if you draw a demand zone around here. So it went up. The body did not close up actually. This candle's body, but the next candle's body opened up. So if you took an entry and placed your stop loss, you would have faced a loss. So definitely, if you keep this low, you would have faced a loss. So this low, the stock price has not broken still. So if you keep slightly below low, the stock price has not broken, but I assume the stock, uh, who knows, it might come down or it might go up. So this is a failure. This is a fake out. It just broke out. The candle's body is high, the volume also high, but still the body, this is the fake out. So this is how the institutions, since there is a resistance here, so the institutions might have placed a huge sell order around here. So that's why the stock price saw a sell down, came down. So the Nifty has also been bearish. So today and yesterday. So that might be one of the reasons. You have to look at the market structure too. You have to see at the market trend too. So this is how the pattern fails, and you can see this broadening pattern here. So this is the broadening pattern. You can see. The stock price goes up, comes down, goes up, comes down, goes up, and the stock price broke here. So it gave a retracement, come in, come down. So this is the expanding triangle. So even some might use the demand zone. So you can, some might even draw like this. You can see stock price might come to the demand zone, around the demand zone, and it again fell down. So this is how the pattern works. Can see here. So this is a triangle pattern, symmetrical triangle pattern. You can see. So it gave a retest and it shoot up. So your target has been achieved here. So almost double the times it has achieved. So Indian Bank. So next, this is Canara Bank. You can see ascending triangle. It went up. You can see this pattern forms around most of the times and is highly reliable. You can make profits out of these patterns. So hope you guys enjoyed this video. So this is the third pattern video that I have brought. If you didn't watch my cupped handle pattern and head and shoulders pattern trend line videos, watch those useful videos. And if you want to learn trading from me, you can contact me by the number in the scrolling below. So like my video, share it with your friends and family, and subscribe to my channel, and also press the bell icon all button so you get notified for all my videos, and also comment on my video if you really liked it, and it would make me motivated to create more videos for you guys. And if you want to open a Demat account, I have given Zerodha link in the video description, all my YouTube videos description. You can open your Demat account online and start trading from today onwards. So hope you guys enjoy this video. So thank you. I'll visit you on my next video. Until then, bye bye. Take care.